Hey there, welcome back to my channel. Today we're going to dive into a hot topic that's been buzzing around the real estate world, house hacking. You've probably heard about it, right? So buying a multi-unit property, living in one unit, and then renting out the rest. It's a brilliant strategy, and today I'm going to show you how to do it so that you can have other people help pay your mortgage payment. Sounds good, right? Let's get into it. Now there are 5 different agencies or loan types that you can use for this strategy. FHA, Fannie Mae, Freddie Mac, VA, and USDA. Each of these allow you to purchase a 2 to 4 unit property. This is where the house hacking strategy really shines. You live in one unit and then you rent out the others for additional income. It's a smart move, especially in a market with higher interest rates. Think about it. If someone else is paying half of your mortgage, your effective interest rate is about half of what it says on the documents. So your out-of-pocket is significantly less than your actual payment. There are differences between each loan program, including loan types, down payment requirements, credit score requirements, and rules around non-occupant co-borrowers. So that's someone who helps you qualify for the loan, but isn't going to live in the properties. There's also differences in reserve requirements and rules around accessory dwelling units or ADUs. And a big question, can you use rents to qualify? So we'll cover all of that and more, but today we're going to focus on FHA loans exclusively. So with FHA, you can buy a 2 to 4 unit property using a standard FHA loan known as a 203B or a 203K, which is commonly known as a rehab loan. So this type of loan allows you to buy a property that needs repairs, and the loan amount is based off of the value of the property after the repairs are done. FHA also offers a home equity conversion mortgage for people 62 years or older and energy efficient mortgages. So let's talk about loan to value or LTV. So this is how much you're borrowing compared to what the property is worth. With an FHA loan, you can borrow up to 96.5% of the property value that you're purchasing, or 90% if your credit score is under 580. But if you're buying the property from a family member or a business partner where it's not an arm's length transaction, you can only borrow up to 85% of the property's value. So what does that mean? In terms of down payment with FHA mortgages, you can put as little as 3.5% down. That's pretty amazing, especially when you consider that the other loan programs often require a much higher down payment for a 4-unit property. But remember, if your credit score is below 580, you'll need to put 10% down. And if you're buying from a family member or business partner, you'll need to put 15% down. But let's talk about credit scores. The minimum credit score for an FHA loan is 580 if you want the minimum down payment. But if you have a credit score of 580 or above, you can put down just 3.5% and you can buy a duplex, triplex, or a 4-unit property with an FHA loan. So if you're planning to have a non-occupying co-borrower, someone who's helping you qualify for the loan but isn't going to live into the property, that's permitted with FHA. However, the loan to value ratio will be 75%, meaning you'll need to put 25% down regardless of your relationship with the co-borrower. Now let's talk about reserve requirements. If you're buying a 1 to 2 unit property, FHA doesn't require any extra reserves. But if you're buying a 3 or 4 unit property, you'll need to have 3 months worth of principal, interest, taxes, and insurance payments in an account that you can access. Accessory dwelling units or ADUs are another important aspect of house hacking. These are separate units on the property, like a small house in the back or a pool house. So with FHA, an ADU is considered a unit. So if you have a duplex and an ADU, it's considered a 3-unit property and you'll be subject to 3-unit guidelines. Can you use rents to qualify for an FHA loan? Absolutely. You can use a percentage of the rents from a non-owner occupied unit as income for your debt to income ratio. Typically this number is 75%. So 75% of whatever the rents are can be used to help you qualify for the mortgage. For 3 and 4 unit properties, FHA has a unique requirement called a self-sufficiency test. The rent collected from the units that you don't live in must equal or exceed the principal, interest, taxes, and insurance payment on the mortgage. In other words, the total rents from the other units have to be greater than your mortgage payment. As you can see, there's a lot to consider when it comes to house hacking with FHA loans. It's important to work with an experienced mortgage professional who can help guide you through the process and help you understand all of your options. That's why I created this channel. I've been doing this for years and I love helping people like you achieve your homeownership dreams. In the coming weeks, we're going to be covering Fannie Mae conventional, Freddie Mac conventional, VA loans for veterans, and USDA loans, and how to house hack using those programs also. So make sure you subscribe and hit the notification bell so you don't miss out on any of those videos. If you're in the market right now, congratulations. You're making a smart move, especially if you're considering a 2, 3, or 4 unit property. Your renters will help you pay your mortgage, which is a huge advantage. So take the plunge and let's make your homeownership dreams come true together. Thanks for watching, and remember, if you want to take a deeper dive into this topic, click the link in the description to read the full article. And as always, if you have any questions, feel free to reach out. I'm here to help, and I'll see you in the next video.